Hi class, and welcome to demonstration video number 1 for chapter 15, Learning Plan 4. In this chapter, I will, because the problems and exercises are fairly long, I'm going to make different videos for each exercise. But for like the first set of videos, which are 3 videos, it's going to entail exercise 15-3, problem 15-5, and exercise 15-8. I will have all 3 of these in this one file, and I'll post them in each video so you do have them. It's going to be a little different from the other learning plans as opposed to how I had multiple problems and exercises in each video. In this one, I'm going to have one video per problem or exercise so that you don't sit there for long duration of period for each of these videos. So you have multiple videos, I believe maybe, I want to say maybe 7 videos, okay, because there's going to be 7 different problems and exercises. I believe I might maybe do one video where there's 2 of them if it's short enough so that we only have 6 videos, but I'm going to see how this goes, and then towards the end, I mean, overall, you'll see everything in the learning plan. So, okay. So our first exercise is going to be exercise 15-3. It's located on page 902. And this is going to be on capital leases. Okay. And we're going to do the accounting for the lessee. And the lessee is basically the person that is the user of the asset. So, for example, if you went and leased a car, you're the person driving the car. So we're doing the accounting for that person or that company. Okay, once again, I'll read the problem and then we'll go through it together on page 902, exercise 15-3. Manufacturers Southern leased high-tech electronic equipment from Edison Leasing on January 1st, 2013. Edison purchased the equipment from International Machines at a cost of $112,080. Okay, and the related information, and maybe I should put that in here too. Okay, we got lease terms. That is 2 years, so 8 quarters, 8 quarter periods. The quarterly rental payments, it's going to be $15,000 at the beginning of each period. The economic life is going to be 2 years. The implicit interest rate is 8%. And this is also the lessee's incremental borrowing rate. Okay, so this is our information here. I'm going to put a box around it so we know that it's separate from everything over here. All right, so in requirement 1, it's asking us to prepare a lease amortization schedule and appropriate entries for manufacturer Southern for the inception of the lease through January 1st, 2014. So I already kind of started my lease table here that I made. I didn't want to spend all that time to have you watch me write it out. So I did it ahead of time. And we also have to record then the depreciation at the end of each year on the straight line basis. Okay, they did give us the cost of the lease, which is $112,080, but we can also do it this way. Let's say they didn't give it to us. Okay, let's say this was missing. We can take the payments. So we can look at then, this will be the present value of the minimum lease payment. Okay, they gave us the payments of $15,000. All we had to do was go ahead and use table 6 of your present value table, table 6. And because we know that there's going to be a series of equal payments made at the beginning of each compounding period, and we know that it's going to be at 8%, and it's calculated quarterly, so that 8% would be divided by 4, which then our interest would be 2. So our present value will be the number of time periods is going to be 8. Okay, 8 periods right here. 2 years, and it's calculated, well, interest, well, payments are going to be made 4 times a year, so that's 8 periods. And our interest is going to be 2%. It's 8% annually, but it's calculated 4 times. We're going to be making payments 4 times a year, so 8 divided by 4 is 2%. Okay, so our factor using table 6 is going to be 7.47199. So if we take that 15,000, multiply 7.47199, that should get us to the 112,808. Okay. Let me put another in. Let's say if the cost was not given, so that you know what this box here is for. Okay, this is only if the cost was not given. Then you would make this calculation. Okay, right here. And this is table, let me just put that in here. This is table 6. There we go. But because it was given, that's what we're going to use here. But in case you run into a problem that was not given, this is what you would have to do. Okay, but you would have to determine if, and leases, with leases, the payments will be made at the beginning of the period, so most likely you'll be using table 6. Okay, so it's asking us to create the amortization table, which I already did for most of it. Our lease payments is going to be $15,000 every period. I just put the dates here for the corresponding number of payments made here, so that we know we have to make the journal entry up to January 2014. So far, our first payment here, okay, does not require interest. Okay, so it's going to be a decrease of $15,000 for our first period. For my second period, okay, I'm going to take that 2% times, hold on here. Okay, I have to put my balance in here because with every payment, it's going to decrease that outstanding balance. It's going to lower that payment. Therefore, our interest is going to be lower each time as well. Okay, once I calculate it. So the 2% times the 97080. And I'm going to do this here so that it looks There. Okay, so I'm going to take 0.02 times this cell. I'm just putting in formula so that I can drag it down and create our amortization table a little quicker. Now, when you're doing it in Connect, you're going to have to do it step by step because it doesn't have formulas and such. But this is the easiest way to do it in Excel. Okay. My interest, okay, is going to be $1,942 for that second period. My decrease in my balance, okay, it's going to be 13,058, and then I'm going to take, for my outstanding balance, I'm going to take the 97.80 minus this decrease in my balance of 80, and then my outstanding balance will be $84,022. So did you see how I did that? I basically took outstanding balance, subtract my decrease to equal my outstanding balance for that second period, okay, to calculate my interest for the second period. So my second period, I took the 2% times this outstanding balance equals my interest to decrease my balance of $84,022. Okay, so this cell here basically just took my previous decrease in balance, subtract the interest to equal 13,058. So let me see what I'm going to do here. I'm going to go ahead and copy or drag my cursor over. I'm going to copy the formulas down. Okay, I'm going to see if this worked here. Not sure. Oops. Sorry about that. Didn't want to move that there. There we go. Okay. Again. Stop it. I'm going to delete that again. I'm going to see how this works. Okay. That worked. I'm not sure about this. Okay. So basically, I had to go in there, and this formula had to be, I had to make this formula an absolute value, where, because if I had just done 15,000 minus this, which what I originally did for my formula in this cell, it was calculating the wrong decrease in balance. So I had to go in and see how there's these money signs before and after that that 04 cell. That's telling Excel that, hey, I want to make that, subtract that first cell in absolute, but then you're going to change it to subtract each of these cells after. So basically that's what it's doing. So for this cell, I'm taking 15,000 minus the 1942. For this cell, I'm taking 15,000 minus the 1680 and so on. And that's how I get all these decrease in the balances. Okay. So that's my amortization table. What I'm going to go in here and do is I'm going to take this and put these numbers in so that you know where we're getting them from. Okay, so see how I did this, and this is going to be a little, it's going to be a rounding error. I'm going to subtract 1 here. It's going to be a little rounding error, and this is going to be subtract 1. So there, nope. Okay. There's always going to be a little tweak at the end of the period so that the lease comes out to what we want it to be at the very last period. So that's why I'm tweaking this here. And this was -1, so yeah, come on. There we go. Okay. So that's what we're doing here. It's just a rounding error, so I just went in and tweaked it so that it would equal what we want it to be. It's going to be adjusted for that rounding for the other numbers in the schedule. Okay, so here's my amortization schedule. Okay, basically I just took, for this effective interest rate, I just took 2%, which is what we had figured here, the 2%, multiply it by the previous balance, okay? 2% multiplied by the previous balance. 2% multiplied by the previous balance. So that's what you would have to do here. What you can do is to make it so that it's easier for your homework is go in Excel and create your amortization table based on what I taught you here. Then go ahead and do it in Connect so that make sure that you have all your numbers correctly placed in here in the table so that you don't get confused when you do it in Connect, because I don't think in Connect you can really do that drop down and put in formulas and things like that. So I recommend doing that in Excel first so that you get your tables correctly done. Okay. If you do have questions about how to calculate this again, you can also email me. I'll be more than happy to show you how to do it. Okay. So once we're done with the amortization table, I'm going to go ahead and let's see here. I'm going to freeze panes, and let me just, okay, yeah, what I did was I I froze my panes right here so that when I scroll up, okay, this doesn't scroll up so we can still see it doing our entries. Okay, so for my first entry, okay, we have to, for January 1st, 2013, okay, we're going to make the lease entry for the equipment. So I'm going to debit lease equipment, or most companies, I mean, not every company is going to have that same account. It's going to somewhat be associated to leases, something like this. This is just what we're going to call it. Okay, and this leased equipment was calculated above. In the amount of $112,080. Let me just make this. There we go. Okay, right here or right there, one of those. Okay. Then my least payable is going to be for the same amount. Okay. That's for January 1st, 2013. And for January 1st, 2013, we also had that first payment. Okay. So I'm going to debit lease payable. And I'm going to credit cash for the lease payment. Remember, there's no interest for that first payment. That's what I'm going to do. Okay. That's January 1st. Right, remember now that the payments are made quarterly. So 3 months from January 1st will be April 1st, 2013. You count January, February, March. April then will be the next payment. So April 1st, 2013. We'll make our first or our second lease payment. Now remember, the first lease payment didn't entail interest. Now the April 1st will. So the way we're going to do this, we know we're going to debit interest expense because there's interest involved. Okay, my interest expense is going to be that 2% times the $112,080 minus that $15,000 from that previous first payment. Okay, so that's going to be this amount right here, $1,942. Okay, if you do this calculation, my interest expense is $1,942. Okay. I'm going to also debit my lease payable to lower that amount, which will be the difference of the cash payment that I'm making, which is the lease payment of $15,000. That's always going to stay the same. So if I took my $15,000 minus the $1,942, I get this amount. Okay, so basically just going down and making lease payments, or making the journal entries for this array of numbers here. Okay, and showing you how to calculate. Let's say we didn't have this table. We can go ahead and also keep track of the payments that we made, okay, and the interest we made. But it's harder to do that. It's better to just lay everything out here so that you know which numbers to take. And okay, there we go. All right. Okay, so that's April 2013. All right, the next payment will be July 1st, 2013. Okay, we're gonna have the same thing, except that this time, okay, well, we know we're going to have interest expense. Okay, and this interest expense is going to be that 2% again, times the $84,022 from the schedule right here. Okay, or you can take that 112,000 minus, you know, there's just too much calculations in there. That's why we use the amortization table, which is this ending balance after the second payment here, 84,022. And let's just say from schedule so that you know where we're getting the numbers from. So let's take 0.02 times 84022. It should equal 1680, which is this amount. And the lease payment then, lease payable will be the difference from the cash payment and the interest expense. There we go. Okay, 13,320, which ties to that number. Okay. Let's go ahead and do the October 1st, 2013. Okay. Once again, I'm going to debit interest expense, and I'm going to take 2% now times the 70,702. Okay. And by now, you should know where I'm getting these numbers from. See how we are reducing that lease payable very slowly each quarterly payment? Okay. See how all these numbers match or tie to what we're doing for that period? Okay, it should tie. And then October is the last year. October is the last payment for that year. Here comes December 31st. We don't need to make a payment as of right now, but we do have to make a few accruals. Okay, we have to accrue for interest expense, and we have to accrue for depreciation expense on that lease. So interest and depreciation expense, depreciation accruals, or adjusting entries. Let's do that. You're more familiar with adjusting entries than accruals. Okay, they're the same thing. It's just worded differently. Okay, so depreciation 31st. Depreciation and interest adjusting entries as of December 31st, 2013. That's when their year end is. Fiscal year end. So we know that we have to make interest accruals. So interest expense. And from October to the end of December, it's only been 2 months. October, November, no, that's 3 months, okay? 3 months. So basically, because the payment's not due until January 1st, we can't really record it with making it as a regular payment, but we have to record it as an adjusting entry. So it's going to be that 2% times 57,116 from the schedule. Okay. So that's going to equal 1,142 right here. Okay. Then my interest payable will be for the same amount. Okay. My depreciation is going to consist of the $112,080 divided by 2 years. Okay, because we record depreciation, well, let's assume that we only make adjusting entries once a year at the end of the fiscal year. And this lease was acquired on the 1st of January, so it's for 2 years. So that $112,080 will be evenly allocated over the 2 years, basically taking $112,080 divided by 2 years. My interest expense is going to be $56,000. Well, let's do this here. Divided by 2, be $56,040. Okay, recorded for interest expense. Then I have to debit my accumulated depreciation for the same amount. So that's my year-end adjusting entry for interest expense and depreciation expense. Then as of January 1st, and usually we wouldn't be working on January 1st, but when you make your entries, we do date it January 1st. I do that when I was the accounting manager for a finance company. When I made my entries or my adjusting entries, I would date it as of the 1st of the month, so that we know that that was, you know, when the payment was made, or if we were to reverse entries, that's what we did. Okay, so we can dictate what they were as well based on that date. Okay, so January 1st, 2014, we're going to make that entry for the payment of the lease. But because we've already, and this entry for January 1st is going to be different from these entries, because we've already accrued for that expense, we don't debit interest expense again, but we actually reduce this payable account, this liability that we created at the end of the year end. Okay, we had to create this liability because that is what we incurred as an expense, but we haven't paid it yet. So this interest payable account is just saying that, okay, when we pay it, we're going to reduce this liability, and that's what we're going to do exactly right here. Okay, I'm going to debit that account, and in my books then I'll have a 0 for my interest payable liability as of January 1st, 2014. So interest payable, my lease payable amount will be the difference from what I paid in cash, which is $15,000. Okay. So that's exercise 15-3. Okay. So every year or next year, they're going to do the same thing. They're going to accrue for interest expense and depreciation. And then January 1st, 2015, they're going to make the same entry. And then they're also going to, that's when the lease expires. So, well, maybe not. No, excuse me. It doesn't. It's only a few more periods. In my mind, I was thinking something else. Okay. So basically, that's what that is for this problem. I'm going to go ahead and delete this so that comes up more. Okay. I'm going to end this video for this exercise, and then the next one I'll continue on problem 15-5. Okay, questions, email me or call me.